Hello everyone, I'm Nova Lui, Head of Investor Advisory at RHB Bank, and welcome to our monthly Investment Insight podcast. Today we are diving into the extraordinary events that shaped June 2025. Over the past month, global equity markets have shown strong performance, with major indices closing higher. The Nasdaq Composite leads the gain up by more than 6%, followed closely by S&P 500 and Japan's Nikkei 225, both rising over 4%. This surge was fueled by optimism around interest rate cut, potential Middle East ceasefire, and positive trade developments. European and Asian markets also performed well, with Shanghai Composite and Hong Kong Hang Seng both posting gain of around 3%. Notably, Japan Nikkei jumped driven by robust semiconductor stock and supportive economic data despite ongoing US-Japan trade uncertainties. India's Nifty and Malaysia KLCI saw more modest increase, while Singapore Straits Times Index lagged behind. The only major indices to decline was the Shanghai Shenzhen CSI 300, down slightly by 0.76%. Overall, June was marked by broad-based appreciation across global equities, reflecting renewed investor confidence and easing geopolitical tension. Starting with monetary policy, where we saw a fascinating divergence among major central banks. The Federal Reserve held rates steady at 4.25% to 4.5% for fourth consecutive meeting in June, maintaining their cautious stance as they evaluate the economic impact of government policies. Despite keeping rates unchanged, the Fed continues to project 2 rate cuts later this year, with market anticipating the first cut in September 2025. Across the Atlantic, the European Central Bank enacted a 25 basis point cut after inflation dipped below their target, bringing the deposit facility rate down as part of their ongoing easing cycle. This marked the ECB's continued commitment to supporting economic growth as Eurozone inflation averaged 2% in 2025. Perhaps the most surprising move came from India, where Reserve Bank of India delivered a 50 basis point rate cut that caught market off guard. Most economists has expected only a 25 basis point reduction, but RBI went further, also cutting the cash reserve ratio by 100 basis points to inject approximately 2.5 trillion rupees of liquidity into the financial system. China's People's Bank kept rates unchanged in their June meeting, maintaining the 1-year loan prime rate at 3% and 5-year rate at 3.5%. This pause followed a 10 basis point cut in May and signals Beijing's cautious approach amid ongoing trade tension with the United States. Speaking of US-China relations, June saw a significant development in the ongoing trade saga. After intensive negotiation in London, the two countries reached a framework agreement that was openly declared done, though important details remain unresolved. The deal established a tariff structure where US maintains 55% tariff on China goods, while China maintains 10% tariff on US goods. China would supply full magnets and any necessary rare earth upfront, while US would provide access to American universities for Chinese students. However, sources reveal that crucial national security issues remain unsolved. Beijing has not committed to export clearance of specialized rare earth magnets, and US military suppliers need for fighter jet and missile systems, while the US continue restricting China's access to advanced AI chips. This suggests the broader trade relationship still faces significant hurdles despite the framework agreement. Perhaps the most dramatic event of June was Israel's Operation Rising Lion, a 12-day military campaign that began on June 12 and targeted Iran's nuclear facility and military leadership. The operation represented an unprecedented escalation in Middle Eastern tensions, with Israel conducting wave of airstrikes against Iranian nuclear sites. The conflict saw the elimination of key Iranian military leaders along with 6 nuclear scientists. Iran responded with missile barrages against Israel city with over 500 rockets and estimated 1,000 unmanned aerial vehicles launched towards Israel territory. Finally, on the economic policy front, Malaysia implemented significant change to its sales and service tax structure. The expanded SST framework, which took effect on July 1st, introduces a dual-tier sales tax system of 5% and 10% on consumer goods, while maintaining exemptions for essential items like rice, chicken, and local products. The 5% applies to near-essential imported items such as smartphones and cosmetics, while the 10% rate targets luxury goods like imported alcohol and higher-end leather products. Additionally, a 8% service tax now applies to business services including leasing, logistics, and advertising, adding new cost layer for retailers and importers. The government expects this expansion to generate an additional 5 billion ringgit annually, while taking steps to minimize the impact of basic consumptions and small businesses. SST somewhat dampened local investor sentiment due to concern over inflation and declining purchasing power. However, sentiment improved with news of potential interest rate cut by BNM in July 2025, which is likely to be positive for both equity and bond market. That wraps up our summary for the key event from June 2025. Thank you for tuning in, and we look forward for bringing you another in-depth analysis of global development next month. Don't forget to connect with your relationship manager to discuss opportunities for rebalancing your investment portfolio. Until then, happy investing.